I just want, before we started here, I just want to get a sense of how many people here are in my business plan development class next quarter. Okay, you guys got A's right away. You know? there it is. We're set. There's no problem there. And how many are in the EA group, in the Entrepreneurs Association? Okay. And how many of you want to be entrepreneurs? Good. How many are going to become entrepreneurs as soon as you graduate? All right, good. All right, well, I'm going to direct this and how about any healthcare people here? Oh, good, because we have 2 portfolio companies in the healthcare industry. How about internet type of people? How about finance people? Okay, so they were all, the same people are raising their hands for like 6 things. That's okay. All right, good. Look, yeah, that's right. And then learn it afterwards, right? Okay. Look, first of all, let me thank Andrew Upchurch for doing all this work, for putting this whole thing together. When he, and Heidi from Stubbs Alderton really helped get this whole, really great. And Stephanie, I kind of don't have to thank because she works for me. But she did a lot putting this whole thing together, and it was really good. And of course, Ryan, who I'll introduce in a second, who's a partner here at Stubbs Alderton. When Andrew told me you guys are doing field trips, you know, I immediately thought of Bring Your Daddy to Work Day or something like that, or maybe Bring Your Kid to Work Day. I mean, you know, I feel like I got to tell you everything about SJIC, SJ Investment Company, and our portfolio companies. I probably stuck in too much information. I don't even know where. How many of you are first-year students? Oh, okay, good. Because I'll lay out the framework first. But I didn't know where you're at in your finance knowledge, entrepreneurship knowledge, et cetera. So I'm just going to try to cover everything. And as I said before, you probably don't have to take my course anymore because we're going to do it all today. So we're going to go through a real-world experience of entrepreneurship, and I'll direct it to, you guys want to be entrepreneurs, a lot of you. How many of you want to be venture capitalists? Okay, more than, okay. So we're going to look at it from both the entrepreneur side and the investment side, and we'll talk about sourcing deals, making investment decisions, portfolio management and guidance, and try to give you a little bit of an understanding of, or just a little different perspective of what really goes on, as opposed to what, you know, the academic analysis is. So a little bit more of that. So basically, we're talking about examining the entrepreneurial process through the eyes of an early stage investor and an entrepreneur. And as I said, sourcing deals, investment thesis, valuation. We'll talk about valuation and dilution, the progress of our portfolio companies, the nature of SJIC's role with those portfolio companies, and how it changes over time, current opportunities and challenges. And I have with me, in addition to myself, the CEO of Medicus, as well as SJIC, we have MIQ and Derelicious executives here with us. We'll talk about internship opportunities as well as their companies, give you a flavor of their companies. So in order to do this, I want to start by first saying Ryan Aslan it has been SJIC's attorney for a while. Stubbs Alderton is a big name in the entrepreneurship legal area. They sponsor a lot of events. They even have a pre-accelerator. So I'd like Ryan to just spend a couple of minutes talking about Stubbs and about the pre-accelerator.
Okay, thanks, Dan. I guess I'll stand up so you can all hear me better. I'm Ryan Aslan. I'm a partner at Stubbs Alderton. Martin, thanks for everybody for coming here. We're glad to have you and host you. I don't know how many years it's been since we've been working together.
About 4 or 5 now, yeah. You look a lot older. Touche, touche.
So real quick, our law firm, Stubbs Alton and Markleys, is a full-service business technology law firm. We're based in Los Angeles. We have this office here in Santa Monica, and we have kind of our home-based office in Sherman Oaks. We have a full breadth of corporate transactional services that we provide, so day-to-day general corporate work, corporate formation, commercial contracts, the full breadth of corporate finance, so everywhere from doing early stage startup financings to venture capital, to doing debt financings and public offerings as well. Mergers and acquisitions, so buying and selling companies, and then we do securities work for smaller public companies as well. Outside of that's really, our firm was formed in for most of its lifetime, which is 13 years now. We focused on doing corporate transactional work. We do more than that now, so we have a wide variety of intellectual property services we provide, anywhere from copyright, trademark, brand protection, IP strategy, transactions, full gamut pretty much on the IP side. We have a business litigation group that supports our corporate clients, and we have a tax capability which comes into play a lot as well. So we can help companies all the way throughout their evolutionary path, from when they're literally starting up all the way to when they're going public or being sold, hopefully sometime in the future. Kind of our poster children clients for that people know are Skype, which we represented all the way from when they were formed, all the way through their very fast growth to when they were sold to eBay, and then more recently Beats Music, so we represented Beats all the way from when Dr. Dre and Jimmy were forming it to last year when they sold it to Apple. So that's the kind of clients we like to work with. We get involved early on when it's a couple of co-founders sitting around a table, and we like to be able to help them grow and support them through that growth. I personally have been with the firm since it started. I'm a general corporate lawyer, but I focus in our emerging companies and venture capital groups. So I work with a lot of startups and venture-backed companies, and then also on the investor side, representing the people who invest in those companies. So venture capital firms, both here in Silicon Valley and internationally for that matter, and also angel groups and smaller investment funds as well. So that's me and our firm.
Precelerator?
Our Precelerator, which is something fun.
We're sitting in the Precelerator right now.
Yeah. So the room you're sitting in now serves many purposes, but we like to host events here whenever we can. But most of the time, it's a co-working space for a number of companies that we host in what we call our Precelerator program. So we have 5 to 7 startups at a time. They're generally very early stage startups. They apply to get into our program. We let them use the facilities here in the co-working space. We don't charge them any rent for that, and we help them in other ways. As whatever we can, obviously doing their legal work, but also kind of strategic and advisory way. And then we put on programs around that Precelerator program as well that are kind of educational networking, help them get to their next stage in the process. Typically companies are in our program for 4 to 6 months before they move on to either, in some cases raising their first funding round, or in other cases getting into a more formal accelerator program around town or even elsewhere. So I'm the director of that program, and Heidi is also our operational director of that program. So if anyone has questions about that, or you or your friends have companies that you're starting up and want to apply for that, we're always looking at applications and happy to talk to you about that.
Great, thank you. As we go forward, we'll talk about different sources of financing and accelerators. I know you guys have been to Start Engine, I guess, or some of you have been there. Howard Marks, right? Is that what it was? Start Engine? Yeah. And so, what is the role of accelerators, if you want to ask? A lot of this is going to be Q&A at the end, if I can get myself to shut up a little bit. So, as I said, we're going to start with the introductions, and I'm just going to leave the real introductions to Charles and Anthony from MIQ, because they're going to be talking about themselves and their company going forward, and they're sitting over here. And Jorge is with Derelicious, and he'll do the same later on. So the introductions will talk about our company and all these things that you've probably seen 4 times already. So there's our introductions. Let me talk about our fund, SJ Investment Company. So this is interesting. I'll talk about the history of it and how it started. It started with one of my students who came to me after taking my class, and just as he was graduating, and like 2 years later, right? And he says to me, you know, my wife and I really love it in LA, but unfortunately we have a family business and we need to go back to Argentina. And I was wondering, you know, kind of need some excuse to come back here and for some reason. So maybe we'll do some investing here. Would you like to help me with doing some investments? So I said, hey, maybe, you know, and we talked about it for a while, and it turned out that we started on a slow basis and then developed further. So his family has a considerable wealth in Argentina. They were in the gas and oil business and sold their company to Chevron maybe 15 years ago. And he runs a lot of the operations from the family business right now. And we started SJIC from that. So, and the reason I bring up the initiation of the fund is there's also going to be questions about how do we source deals. And a lot of our deals came through UCLA, and even the inception of the fund came through UCLA. But we said we'd start with a $5 million fund. And we thought, well, $5 million, you need to have enough deals in place. We don't want to make one $5 million investment, and we don't want to make, you know, 500, you know, what would that be, $1,000 investments or whatever. We couldn't control it. So we decided to start with a $500,000 approximately investment in our portfolio companies, which was a strategic move as well, because if you look at the market for capital, you'll find a lot of angels there at a lower amount, providing, you know, up to $100,000, $200,000. The angel groups and such will be there. And then there's the venture capital firms, the big ones that are will usually not come down to less than $5 million in their financing. So there's a little bit of a desert there in between the angels and the VCs, and so we thought we would have a kind of a competitive advantage in terms of the amount of money we were giving, because very often, as you'll see with SJIC's portfolio companies, they're going to need multiple rounds of financing, and there's got to be somebody there to take that. So we started we do make investments of less than $500,000, but with the anticipation that we'll have $500,000, but most of them are $500,000. How are we different than others? You know, just like in any other competitive business, we say, how are we different? Well, part of it's my background, or all of it's my background, basically, because, you know, I'm a serial entrepreneur. I'll talk about my background in a second. And so I have operating experience, which we felt would help in that. And that's another reason for the size of our investments. We didn't want too many investments so that we couldn't have a handle on what we were doing with our portfolio companies. Although we have a small staff, I'm going to have my staff stand up, or no, just wave now. Here's my staff, Stephanie. She, by the way, she does the job of two UCLA MBA graduates that work for me. Mark Eckert, who was by the way, he was the former president of the Entrepreneurs Association, and Georgie Thomas. They worked for me for a while. And reason why I want to bring it up is, you know, if you people that want to go into venture capital, you know, I'm sure you're taking all those finance courses and things like that. But if you want to go into early stage financing, you're not going to have a lot of data to work with. You know, if you're making seed stage investments before the product exists, before the business is out there, you're not going to have a lot to do in terms of modeling. Okay, you can model what's going to be, but you know that's fantasy anyway. But you know, so it's a different kind of thing. So I wanted to bring up, and we can talk about this later, maybe in Q&A. You know what the role of an early stage venture capital firm is. You know. And we operate, by the way, on a deal-by-deal basis. So there's a very, you know, say $5 million. They didn't say, hey, Dan, go off and and make your investments and come back when it's all invested. We basically, Federico and I, that's my partner, my former student, decide on, we talk every day almost, or at least twice a week, and we talk about investments and things like that, and together we put together a investment memorandum and decide on our investments, and then he brings it back to his committee, which is partially family and partially outsiders. So for every deal, which makes so when you're talking about venture capital firms or angels versus venture capital firms, you're talking about now committees and things like that. With us, with a family-backed fund, you have, it's interesting. It's other people's money, but it's one family, and they can make decisions very quickly, which is really good. And luckily for me is that every idea or every investment that I've wanted to make, they said yes to. But it could be very difficult if you go and do all your due diligence and work on the thing for a couple of months or whatever it is, and then all of a sudden you find out that they just don't like the idea. So you have to be, as a managing director, you have to be in sync if you're going to do it on a deal-by-deal basis with your investors, which we are. And just quickly, my background, I got a MBA from NYU and a PhD from Wharton, and then I went into business right away. I didn't pursue the academic track. I went to work for a company called Vernitron, which was it was on the American Stock Exchange at the time, and they did hospital equipment and electronic components, and I became the executive vice president eventually after about 4 or 5 years. And then I was in charge of mergers and acquisitions, so I have a M&A background from that. Company was a subject of a hostile takeover after that because we only grew from 80 million in sales to 150 million in 4 years. But it was in the mid-'80s, and it was a go-go time. Everybody was doing hostile takeovers all over the place. So we sold the company because it would have cost us too much. And then I started my entrepreneurial career. And just to make it real quick, because we don't have much time, I started about 4 or 5 companies. I started with a point-of-sale computer company, and which was state-of-the-art at the time, and grew it from 86 to 93, and we became the biggest computer company in the dry cleaning field. So computers for dry cleaners. Get it? And then I sold it, and then I started, then I said, hey, what am I going to do now? I started teaching at NYU Stern. I had this PhD, and now I was an entrepreneur, so I started teaching entrepreneurship there. So from 93 to 2000, I taught entrepreneurship there, as well as, how many of you are familiar with Vistage? Vistage is a CEO group that they come together monthly to help run their businesses more effectively. It's groups like YPO, Young Presidents Organization, but it's the biggest CEO group. And I had two groups of CEOs that I was chairman of for that period of time. And I also then started a consulting firm with about 25 MBAs. We were writing business plans and raising capital for companies, and then it got to be the dot-com companies later in the 90s. So it's pretty easy to write business plans in those days and raise capital. It was kind of a lot of air, So I did that, but my friend said, why are you doing this consulting and writing these things? Why don't you invest in these companies? So I started a fund then. In New York, we had a fund called Washington Square Capital Fund, Washington Square, right by NYU. And we invested in a few companies, and I became the CEO of one of them, gave up the teaching, gave up the Vistage, but we grew that too fast. We went from no sales, basically, to 4 million run rate in 18 months. And the dot-com had crashed, and we were looking for capital. And this is a lesson, because the market at that point dropped the valuations. Okay, you talk about valuations, it's due to market fluctuations, right? And so we went into this particular company with a $15 million pre-money valuation, which I'll explain pre-money in a little bit. But we went into that with $15 million. The company started to go well. We got $4 million in business on the books, and it was only valued at $5 million because of the market there was no money around, okay? So we ended up selling the business, and then I didn't have a job. So I became the CEO and the president of about 3 or 4 early stage companies and grew them. So that's from my operating record that I talked about before. I didn't mean to go so long on this, but my daughter moved out to California. My wife and I came and visited her, and it was sunny in January, so we moved out. And then I got a job working for UCLA, and then SJIC. And Federico, as I mentioned, is he manages his family businesses. They have mines, and they have farms, and they have all kinds they have real estate, and he does that in Argentina and works with me. He was with the Boston Consulting Group in South America, and he graduated, I think it was 2009, he graduated from UCLA. So that's it. We have a family-backed early stage venture fund, investing between $500 and $1 million in seed stage and Series A financing. It's an opportunity fund. I didn't mention that. It's meaning we're not in one industry. Okay, now think about what that means. You know, when Charles comes to me and says, "Hey, would you like to invest in our business?" I got to learn about that whole business. A lot of which I got to rely on what he's saying, which is, I got
mostly all true.
Mostly all true, right? And so, but you got to do your due diligence, and you got to learn a lot about that. So there's a good thing. We see opportunities. I love it. You'll see our portfolio. It's pretty diverse, but we're an opportunity fund in biotech, internet and technology, specialty finance, and custom manufacturing, and that list could grow any day. So I'm getting on. The next subject is, so we started our company, we got things going. The question is, how do we find deals? Okay, and I always get asked that question, and I never have an answer. And because I was doing this whole talk, I sat down and said, how did I get these deals? And it isn't a problem, you know? I mean, it's the opposite thing. It's too many deals. So, I make a joke. Start telling people you have money to invest. Somehow, some way, they find you. You don't have to advertise. In fact, we don't want to advertise. Any of you go on to look at SJIC's website? Doesn't exist. Doesn't exist. You know what? We don't want it to exist. In fact, I may be a little different than your typical early stage venture fund and things like that who, are part of the community. I kind of I feel like I'm a lone wolf on that, so don't take it. I don't need to see so many deals. We have a very small staff here, and it's the good ones, finding the good ones. And so it's also very difficult to find deals when you have an opportunity fund, when you're not looking at one particular industry. So there's so many deals that can come through. So here's for you would-be entrepreneurs out here, how do you get the attention of people like myself and people like all these venture capitalists in the area? Because hundreds and hundreds of plans, and not plans, okay? I teach business plan development, but I have never seen a real business plan come through my desk. Nathan here, who teaches business plan development as well, the whole faculty grapples with the decision of, in business plan development, should we have you writing a business plan or not? Or should it be a PowerPoint? How should it be? I opt for saying you should do a business plan because you cover all the bases. And I wish a lot of the entrepreneurs covered all their bases as the students do, because you got to look at the product, the market, the marketing and sales, the operations, every area. And once you start writing this, you realize what you don't know. So it's really important. But the fact is, I get all these PowerPoints and things like that. I look at more than most, and anybody that comes from UCLA I look at. I feel like it's my obligation. But a lot of these venture capitalists will not look. So go find somebody that knows somebody who knows somebody who will get you a person at one of these companies to look. And this is a real big selling effort, you know, and entrepreneurship is about like being a salesperson, by the way. And whether you like the term salesperson or not, it's the way it is. You got to go out, you got to network. It's good to understand the funder's criteria. You know, where are they? How much are they going to lend? I see a lot of entrepreneurs saying to me, oh, I'm going to start this, I'm going to go get a loan. You know, after I get up off the floor laughing about how who's going to lend to you when you don't have a way to pay it back, or you don't have a constant you have assets and you don't have a flow of income. How are you going to do that? So you need to understand the funder's criteria, what they're going to do, and you have to get good at your pitch, at selling your idea. So that's just a side note. Any quick questions up to the, actually, we're going to do a Q&A panel, so let me get through this, but if you do have questions. So sourcing deals, how did I source them, really? Okay, so Medicus, you'll see, and we'll talk a lot more about this, I'm CEO of Medicus, and the reason I'm CEO of Medicus is a polymer-based drug delivery platform. We'll talk more about it later in the healthcare industry. And Nyan Asher was an executive MBA student of mine, said, oh, would you help us? You know, after we went through his plan in my class and all that, and when at the end he said, would you like to be CEO of our company and help to help us raise money? Because what do I know about that industry? I didn't know anything. And I said, okay. And then just about the time when I was starting the fund, SJIC, is when we got involved in this. And it turns out that it's SJIC that did the investment in Medicus. So I found him through UCLA. That's how I got the first one. Micropower, the Tech Coast Angels. You're all familiar with the Tech Coast Angels? Group of angels, big group. I'm a member of the Tech Coast Angels. And I'll tell you the story about how that came about, but I found them through the Tech Coast Angels. Micropower is a low-power video surveillance camera that only requires a battery and solar panel. Thank you. See, good. Okay. Otherwise, I could never think of the words. Very interesting opportunity. Ritter Pharmaceutical. My daughter Ashley, who's a FEMBA grad, by the way, 2011, I think? 2011. You were 2001? 2012? Yeah, he was in my business plan development class, too. That's how I found him. Where is he? Number 4. See? MBA student. That's Jorge. Ashley was playing softball on a co-ed team. For some reason, she's not that good. They put her at shortstop, you know? And the third baseman was Andrew Ritter. And Andrew Ritter played for USC. So everything was good, except one day she came back with a real big shiner. And he didn't protect her on third base like he was supposed to. So I was mad at him. But she told me about him. He came up with a cure for lactose intolerance in the 8th grade. And it's been a long gestation period because he's now 32 years old. We'll talk about this cure for lactose intolerance that we invested in. Daralicious. Daralicious. What is Daralicious in one line?
The online destination where you can dare yourself, your friends, or a celebrity to take on a dare, all while earning money for your favorite charity or cause.
Okay, you got that? Maybe he'll talk about it more later. And then for Translogic, MIQ, what's your one-liner?
We help merchants understand who their customers are based on their credit card transactions.
There we go. And we know how I found Jorge. There was a broker involved in this deal, right? Investment banker. That's how we found you. Interim lender. I skipped that one. That's a finance company. They do interim loans. They started with interim loans for the 504 loan program, SBA 504 program. And I was friends with the president of Gilmore Bank, so I found them through there. Staging Concepts is they make stages and railings. That was a private equity deal we did, and I'll tell you about that. And I found that through a UCLA student professor kind of that. He was a student and a professor there, and he introduced me to the private equity company who told me about Staging Concepts. And then MediaPass was through a broker. So that's how I find deals. That's how I source them. But that's the easy part, and that's the quick part. The question is, how do you find good deals? Okay, how do you decide what's our investment criteria, so to speak? And a lot of this goes back to the real issues of your of academics. I teach it. We teach it. These kind of rules about, you know, the product market size and all of that kind of thing. We look at two things. One is the opportunity. The other is the entrepreneur and team. And which is more important? They both got to be there. They both got to be there, but that team is more important. And why is it that the team is more important, you think? They'll be, yeah.
At such an early stage, the product or the value prop might change, but the team is still.
Yeah, that's the, you know, yes, they have to execute. So, you know, that's key. But the early stage, that value proposition, the business is going to change. I put it in different terms. I say shit happens. And they have to get around that. They have to move around that. And the real good ones will be able to find a way to make things work, and the others won't. And that's what it comes down to. And by the way, it's not only, I think, it's not only can they pull it off, can they make it happen, but can we work with them? Do we have a good relationship? Do we communicate well? You know, what's going to happen when stuff happens? Are they going to run for the hills, or are they going to work with us and look to us? We like to have an operating role in our companies. So, other considerations. Okay, so you have to have the right team and you have to have the right idea. Can they pull it off? Then other considerations, okay? Valuation, you know, is sometimes you can't come to an agreement on valuation. The terms are more important than the valuation most of the time, okay? So if I know I'm going to have a preference, for instance, which let's say in one of my deals, which I'll tell you about, we're putting in money now. They're making us put in money, but the money that goes in is a 5 times preference, meaning if the company sells for, in this case, $25 million, the first $25 million comes to the people that are putting in money now. And then the rest, then the money goes to everybody else shared. So the terms of the deal is very important, and our role in the company. We also have internal issues. I will tell you, our decision making changes as we get along in both our learnings. What does our portfolio look like? How much money do we really have? You know, in the beginning, it was easier to spend because you had more. You're saying, okay, well, this is the first deal. We have plenty. We know we're going to have $5 million. When we get down to the last deals, we say, well, do we want this one or this one? Our decision making gets a little slower. And then there's some other things like, is it a sexy business? You know, we thought about, oh, we should go into the entertainment field. You know, if we found one, we would, you know, be exciting. So there's all that too. You know, you can do this analysis and it's great. I can line up, and I will line up for you everything we want to see, okay, in a second. But then no business has all those things, and you have to kind of decide what you can live with and what's really important. So I look at it as, and this is for you entrepreneurs as well as how we look at it, and this is how do you analyze an opportunity, and it all comes down to the value proposition that the company has in terms, not in terms of the management side, but in terms of the idea, okay? So what is and this is how you would, you know, this is from my class, what you would do to do your pitch or something like that. What is the problem? What is the pain you're trying to solve? And whose pain is it? What is your target market? What is your specific target market? How will your company solve that, the product or service? And how strong is that? Are you solving the problem? Is it a cure for lactose intolerance? Or is it just like it'll make you feel better for a little while until you have milk again? That's the question. So is it a cure or not? What are the current solutions? The competitors? Why isn't it being solved? Why is that solution better? Can you protect the idea, patent, know-how, etc.? Is it sustainable? And you put all those three together and you got your business idea, and that's the kind of thing that you want to have come across in your business plan, in your PowerPoint, in your pitch, all about what your value proposition is. So it's the pain or need, target market, your solution, current solutions, why it's better. And then, on top of that, where are you now? Okay, big thing about stage of development of the company. We say if it's a seed stage, do you have the product? Are you generating revenues? That's a key. Where are you going? What's your vision? How will you get there? What will you need? What do you need to get there? Next steps and action plan. These are the things we look at as you would as an entrepreneur and we look at as a venture firm to get satisfactory answers to this. And we want, look, just like everything else, as I said, you're a salesperson. You want a compelling story. You want that wow factor, okay? And can you pull it off? This gets now into the team. Can this team pull it off? Do you have proof of concept? Do you have validation that you can build it, that's needed, that people will buy at your price? This becomes incredibly difficult if you don't have a product on the market selling yet. And this is where all the risk comes from, right? Are they really going to do it? And who are you and who is your team? Can you make it happen? And do you understand the key risks? Okay, so seed stage investments. I don't know what the statistics are anymore. It used to be over 80% failed in the first year. I'm trying to be conservative now and say over 50%. I think more are succeeding because of entrepreneurial education and also because of the types of businesses that there are out there now. Internet businesses don't cost a lot to get into, so they can have more of a chance of survival. But they fail. Why do you think they fail? In the interest of time, I'll tell you. You're dealing with assumptions in the early stage. I'm talking about the early stage, And what you need to do instead of dealing with facts and like extrapolating from there, you need to identify the key success factors. Product, can it be built? These are the things that these are probably the major causes of why you're going to fail. You can't build a product. Or you can't build a product to specs, to what you thought it was going to be, to what, and maybe the customer doesn't want it because of that. Or you can't build it in the right time frame. Or you can't do it on budget, or all three, okay? Or the market demand, You're saying how many people will buy, in what time frame, for what price, and when will I get paid, okay? And finally, execution, So there's all kinds of reasons why you're going to fail. If you take away one thing from this talk, the goal of an early stage company is survival. Period, end of story. And why? Just because of what was said before. Things are going to change, okay? You've heard of the lean startup. It's all about testing assumptions. And if you have a product that you can get out to the field, you're going to have to do a lot of tweaks back and forth until that time where somebody's going to accept the product. I think that this rate, the failure rate, would go down tremendously if companies had enough money to get to the right place. Sometimes they just keep on spending forever, okay? But a lot of times you just run out of money before you get the right idea to the right people and you start generating enough money for that. And you're going to see this in our portfolio because everyone, I'll give you a preview, everyone, including the guys sitting here, took longer than they thought, and it cost more than they thought to get into it. And if there wasn't, what's that?
Let's just say lies.
Lie. and if it wasn't, if you didn't have the source of capital or couldn't get it, you'd be in trouble. Now, but on the other hand, you can still be building towards it and be getting capital in the interim. And now you'll see what happened with this. So, one other thing. So that's this side I look at, and it's of course in general about the idea and stuff like that. And we do our due diligence. There's a lot more to it. How am I doing on time here? I'm okay. Okay. And then the question is people. So it's good enough to say, I see these guys, hey, they're good guys, you know, management, they're good guys. What makes them good guys? I mean, this is a real subjective thing. You know, we talked about the idea being subjective. This is really subjective. How do you know, you have to sit in and look across people and say, so the three most important success factors are management, management, and management, okay? And I look at it this way: credibility, commitment, and contribution. That's what we're looking at. And let's talk about what I mean by that, okay? First of all, credibility, commitment, and contribution, they're kind of overlapping. So when I say certain things go into credibility and certain things go into commitment and certain things go into contribution, you could put them in any I'm just trying to create a framework. And this is kind of like academic, but when you think about it, this is what people look at. And let's talk about it. So credibility, the first thing. Track record. The biggest thing is, are they a new entrepreneur, or you know, have they done this successfully a few times? Did they work for a company that is in the field, and do they know the field? Do they know the market? Do they understand that? Do they have that real market knowledge? And have they been successful in the past? Very important kinds of considerations. And you talk about valuation, you know, I mean, if you got Bill Gates walking in here and he said he had an idea for a business, okay? Could he raise money at a high valuation? Yeah, you know, and it really does. So the idea doesn't matter at all in that case. So you're talking about management, the knowledge of the entrepreneurs make a big difference. Do they have a realistic plan? Okay, you're going to lose a lot of credibility if you don't have a realistic plan, and in an early stage that it's a phased plan, that you know that you're going to get to one place and then the other and then the other. And it's fine for say, you need $500,000 now, you're going to need $1 million later, you're going to need $3 million. The more you know that, the better. And actually, the more you know how you're going to market and sell, to me, shows a lot of knowledge about the industry, how specifically you're going to sell. And whether you have team skills, okay? You're going to have to build a team here, so that's a big part of credibility. The commitment is, what are you going to do? What are you giving up to do this, okay? Time, savings, money. These entrepreneurs that come to me and say, oh, by the way, I'd like you to invest in my business. What have you invested? I say to them, nothing. You know, I don't care. If you have $10,000, invest the $10,000, or at least take a pay cut, or do it for nothing, or show that you're committed to this, because this is not a job. This is not being an employee. This is owning a company. So you really need to see are you going to, you know, are you a 9-to-5 person? 9-to-5 people can't make it in this world. If you're planning on going home and at 5 o'clock every day, no matter what's happening, you're going to fail. So, and you got to get to know a person really well, or the team really well, in order to make that assessment of that. Okay? The biggest thing and the easiest thing to see, and it goes along with the financing kind of things, is what have you done? Okay? Have you sat in your room and tried to write a plan and not even talk to anybody in the field? Have you created a prototype? Have you done your market research? Have you done the plan? Do you have your buyers and sellers lined up? Do you know what your rent is going to be? Do you know where you're going to be? You know, specifics, and And the more you've done, the more credibility you have. And the closer you get to selling the product, the more credibility you have. So if you have customers, that's great. You've contributed a lot, and you've done it on your own dime. Now I'm going to show you, just got about 5 more minutes of this, and I'm going to show you why it's so important to do it on your own dime in the beginning, as opposed to trying to get money really early on. Okay. Oh, by the way, more contribution? Do you have your team recruited? Do you have any patents or exclusivity, etc.? So, first of all, where can you get money? Okay. And how do you value a company before it even starts? Well, you can go on projections, and you should see some of the projections of my portfolio companies. Boy, oh boy, I wish. We wished in the beginning. But anyway, you can go on projections. You go on comparables, what's out there, and what is the multiple of earnings that these either purchases are taken care of or done, or if it's an IPO, kind of thing. So there's a certain level of return. So sometimes you can't decide, you can't come to an agreement on what the value is going to be, because the entrepreneur, these guys are smoking something over there. They think they got an idea, and they think it's worth a fortune, and that I can give them, it's like Shark Tank, right? Just think of me as the bald guy. What's that mean guy? But anyway, it's the fact is that if they think it's worth one thing and you think it's worth another, but you think it's a good business idea, what do you do? Okay, so maybe you structure it as convertible debt, and you say, let's not decide now what it's going to be. Let's take the next round. That's assuming you have financing that's needs later on. And the next round, when we have our product or whatever in a certain length of time, it's going to be worth, people are going to invest at a $5 million valuation, for instance. Well, at that time, I'll issue you convertible debt, and it's convertible into equity at a 30 or 40% or 20% discount from that round. So you've eliminated an issue of what is it worth now. Now, I don't like that, because my upside is kind of down, and I'm taking such risks. So usually I say, okay, but at least it's got to be $3 million. The highest valuation it could be is $4 million or something like that. So if it's $10 million, I get the benefit from 4 to 10, if you understand what I'm saying. Okay, so you can do it that way. And really, I don't know how much, a lot of you are first years, but I'm not going to spend a lot of time on this. But your sources of funds are kind of limited as an early stage company. You can use your own, and you should in the beginning. And mortgage your house and take out a lot of credit card debt. I'm not suggesting that, but that's kind of what you have to do. You go to friends, family, and fools when you're just starting out. I put this on for Jorge because he's in the crowdfunding business now. And now there is a potential to get money from crowdfunding. Angel investor or an angel investor group is next. Venture capitalists, but they're usually higher. We're an early stage venture capitalist, so that comes in there. You can get microloans or government grants. It's usually based upon your own credit worthiness. Bank loan or credit, you're not going to get that, you're not going to get that, and you're not going to get that. In fact, if you could take a look at the bootstrapping sides, you've got founders capital, savings, credit cards, second mortgage. Then you get that, and early sources would be from friends and family, angel groups, and early stage. This is basically what I said before. Later, you can do lines of credit and SBA loans and things like that, and later stages of equity financing or venture capital firms and such. Just so you have a clue. Now, here's the thing. What do you think an investor, if they would invest in your idea today, okay, it's an idea, it's only at an idea stage, what kind of return annually do you think they would want? Anybody? Come on, you're a venture capitalist. I'd say a little bit greater than 20%. I'd say if you're going to get capital to, say, do a prototype or plan, I'd say it would be between 70 and 90% annually. Okay? That doesn't mean you're getting the money annually. That's the kind of return you're going to want. And that's because of the risk that's involved in this. Because 9 out of 10 at this stage, or 8 out of 10 is going to fail. A lot of them are going to fail, or they'll succeed but not get to your target. Okay? Now, as you get going, a startup, let's say you have already the product. That's important. You got the product, you got a market test, maybe they'd want 50 to 70%. First stage financing, now you're talking maybe 40 to 60. You're already manufacturing and shipping, but you didn't reach break even. You got to build and execute, build a company. You're just starting to get sales, and you're moving out after you manufacture and ship. You want those kind of returns. And you build an organization, you get it going, and you still need equity financing. You're talking 30 to 40%. And if you want a bridge loan to get to the next phase, you're talking 20 to 30%. What does this mean? This means big time. If you're going to get money, luckily most of the time you don't need a lot of money here. You can do it yourself, okay? Because look how big your idea is going to have to be in order for you to end up with any capital, any equity in the company, I mean. Here, I'll give you an example. Usually I take a long time with this, but I'm just going to say, let's say you need $250,000. Let's say you need money for your business, okay? And the first round, you're going to need 250, 500, and 750 in 3 tranches, okay? And you start out, you own 100% of the company, okay? And you need $5 million, okay? And for 100%. So if in the formation, if you were to do $250,000, you get an investor to do $250,000, their target rate of return is 80%. What they're going to want is $1,458,000 in 3 years. That's compounded 80% for 3 years, right? That's pretty good. 250, not bad. And then they'd have to own 29% of the company then. If they do a market test, they'd need, in year 1, for instance, 60% return. They'd have to have $1,280,000, and then they need a 25% share at the end in order to realize that. I don't know if I'm going too fast, but in order to realize, if you're getting $5 million, in order to realize $1.2 million, you'd have to have a 25% share.
$5 million is the exit value.
Exit value. Exit value. Yep. Thank you. And then manufacture and ship. Okay, there's only 1 year left. You need $750,000. They need a 40% return. The share is $1 million. They'd have to have 21%. Okay, so that's 3,788. They'd have to get out of that $5 million, and they'd own 75.8% of the share. And you, entrepreneur, you guys still maybe not want to be entrepreneurs anymore, are now going to have $1.2 million or 24% of the company. That is a lot better than 100% of nothing. Okay, but this is how it works. And the problem is, if you don't get far on your development, you end up giving this out at a higher rate, and you end up getting diluted, and the value gets diluted as well. There's a difference between stock dilution and value dilution, right? And so, as long as you're getting money in at each different tranche at higher valuations, your valuation is going up even though your stock value is going down. And that's, I don't want to get into this whole thing, but I did want to talk about this because I want to talk about you for entrepreneurship, for venture capital, and to show you what's happened to our portfolio companies, which I'll talk about in a second. So at the end of the day, the market's going to determine the valuation. How do you see that valuation we just did? We said, okay, it's going to be worth $5 million. And that's what you do. You sit across the table and say, this company is going to be making $500,000 and 10 times that will be the exit value because of what's in the market now. and we're going to do that in 3 years, and therefore our company is worth XYZ. In reality, the companies are worth what anybody's willing to pay for it, and it really depends on the riskiness and the stage and what the market is. So if you want to looking for capital, I wouldn't say to stay in LA. I'd say to go up to San Francisco. The market for they have much more money floating around. This is a supply and demand kind of thing. So they have more you can get. Now, a lot of the people up there won't invest down here, vice versa. They want to invest with companies where they're at. But it's a market-driven thing in the end, okay? And because, as we mentioned, survival is so important, it's better to be overcapitalized than undercapitalized. The problem is, as you see, if you get overcapitalized in the beginning, what happens to your ownership share? So it's a juggling act, okay? And it's hard for somebody, a green entrepreneur, to really convince that it's worth a lot because they haven't done it before. Okay, finally, this was all prelude, because I didn't know where you're coming from, and understanding of how venture capital works and financing works and stuff like that. So here's our portfolio companies: Medicus, Ritter. These two are in biopharma. Deralicious, MIQ, and MediaPass are three internet type of companies, and Micropower. There's a finance company, and then we have two kind of, you'd say, technology and then manufacturing company. And I think I mentioned these to you, and you'll hear a lot from Medicus through me, MIQ, and Deralicious. Okay, but I want to go through this one in particular. This is a great case study of what I just talked about. Micropower, this is the group I found through the Tech Coast Angels, the company I found through the Tech Coast Angels. There were about 20 Tech Coast Angels that invested a total of $360,000 in the company. And this is a funny story. So I'm at the Tech Coast Angel meeting, and they had already invested, and the CEO's giving another presentation to come out for more capital. And so I go over to him, and after his talk and when other things were going on, I put the card in front of him, my card, and on the back I say, we invest $500,000 up front, And so I got a call the next morning at 6 a.m. And, they, first of all, they manufacture low power wireless surveillance, and they have video cameras that operate on batteries and solar cells, and there's a big market for remote kind of things. Imagine, first of all, it could be moved. You have an event, you have the marathon, you could put them up all over the place. You have them at universities, in dark areas where it's hard to get electricity to. Have them at big market is the gas and oil industry, on pipelines and things like that. You don't have to fly a drone into it, and stadiums, in all kinds of areas. Okay, so there's this big market. So this was one of our first investments. We invested $500,000 initially. It was a very interesting deal they had. The deal was that it was based upon the size and the time. They said, the valuation was approximately $4 or $5 million. But if you invested more, they had a chart. So if you invested 2 months before the closing, you got 2% discount for each week or something, or each month before the closing. And the higher you invested, the more discount you got from this. Actually, it was a $7.5 million valuation, and they kept on giving discounts for all these things. Well, we came in and we broke the chart because we were off the chart. They were the amount. So we invested pretty hard, and we got them down to about a $4 million pre-money valuation at the time. And so there's pre-money. That's everybody. I'll just say it. Pre-money is the value before the money goes into a company, okay? So if the company is valued at $8 million pre-money, okay, and $2 million goes in, The value of the company now is 10 million. So that's pre-money versus post-money. It's a simplified way, okay? So we owned post-money 8% of the company. Importantly, terms are really important, okay? Everybody prior to us had common stock. We had preferred stock. Preferred stock has and this is where I even rely on Ryan a lot, and we go through, well, what kind of conditions or terms should we put on our offer, okay? And depending on how much money we're investing and what stage and who else is in there, we can dictate terms or not. You know, one of the ones I mentioned was a preference, okay, that we get our money back beforehand. There's a before anybody else in case the company sells for a small amount. So we're secured on that. And people have there's agreements that show 1 times preference and 2 times. So we get, or 3 times and up, you know, up and up. But that's not usual, but you can get all 3 times your money back before anybody else gets it. So you'd, instead of converting to common, you stay with preferred and get 3 times your money back if the price isn't it as well. I don't want to go into all details, but I just want to bring up the fact that the terms often mean a lot more than what we focus on and focus on the valuation. So that total round was about 2 million. And they said, by the way, with this round, we're done. We're finished. We're going to get to break even with that money. And they had a working prototype. Federico and I we went out to the parking lot, and they had like a quarter of a mile away, they had the video camera, and they went to the hub, and we saw it on our computer. We said, oh, these guys are pretty good. They're far along, okay? And so let me, rather than, I'm going to read you what my investment thesis was at the time. And this should be interesting to you. Micropower is a San Diego-based company. They have a low-power wireless surveillance system. They have a design and preliminary implementation, FPGA-based, of wireless communication and control chip. Their system has unparalleled power savings features, robust and encrypted wireless connection, easy to configure system setup, and a web-based communication hub. They also filed patents on their chip design and some of the surveillance algorithms, starting from Europe. Based on their claims and at least 2 years technology advantage, they believe they can break into the surveillance market as a game changer and maintain very high growth rate at high margins. Then I write, this is an internal communication, okay? From their mouth to God's ears. If Micropower met 100% of their projections in 5 years, earning $58 million, and sold for 5x pre-tax profits, 5 times pre. By the way, the multiples in this industry are like 10 times sales. So forget it. You know, this is really being conservative. 5x pre-tax profits. And we discounted completely the $77 million in cash that they will have on their balance sheet, they say. Then SJ's $500,000 investment would be worth $44 million. That would equate to 145% IRR. Assuming the performance at 50% of projections, I was being nice, 29 million pre-tax and a 3x multiple and a 50% dilution of our equities, meaning others would come in. I'm calculating that. SJ's investment would still be worth 12 times our investment, 6.5 million, which equates to an IRR of 67% annually. Remember those percentages I told you about. Okay, so discussion. Anyone's immediate response is that the projections have to be wacko. And the likelihood of them achieving their 100% performance number is incredibly optimistic and unrealistic. So this is me saying it about this company. On the other hand, they're serving a segment of a huge and growing market. They have a unique product with patent protection, a head start, and some trade secrets. They have demonstrated the product can be done with their prototype. They have an experienced and extremely driven management team. See, I'm hitting all the points that I talked about before. That's why I'm saying this. That has consistently met projections. They're willing to make personal sacrifices to make this succeed. They have an established, good, important relationships with suppliers. They have a very well thought out market entry plan. They won a number of prizes for the disruptive technology and were selected as one of 6 firms out of 120 to be accepted into the Evo Nexus incubator, where they have free rent and access to a team of advisors. The sales projections of $150 million is not out of line with the market opportunity. Their projection of 65% gross margin still puts them at a price of 1/10 of their competitors in situations where installations are difficult and they have no competition when wiring is impossible. Their margins may be higher because they are thinking of raising prices because of these reasons. All this being said, do I think they'll make those numbers? No. Do I care? No. If they perform anywhere near their projections, SJIC will have significant returns. So you can see we're talking about orders of magnitude and not really sharpening the pencil so much because it's such a big opportunity. So what happened? Even though they had a prototype, it was really difficult to get the product out. There were engineering problems. They went through engineer after engineer after engineer. The features, the market needed better features, different features. They kept on changing things. The CEO couldn't execute on what he was doing. The CEO couldn't build a distribution channel, which is very hard to build in the field. The CEO and team got replaced because a deep-pocketed investor came in to save the company, basically, because we ran out of money, okay? Actually, we did another couple of rounds, and then the deep-pocket investor came in. They needed more capital. To date, they've done 4 rounds of capital, $25 million invested. The latest round is they came to us and said, well, you know what? We need an investment, and we're going to do this $5 million new investment. And by the way, if you don't, everything's getting converted, all your existing stocks getting converted from preferred to common. It's getting, and if you don't invest in this round, you're going to get 1/10 the amount of common stock than you deserve, than you would have. It's called a cram down. And if you do, you get to keep your thing. But you get preferred stock. And I don't know if, did I talk to you about this? Yeah, we got to talk about this. Okay. There's the money you get, now we have to put in basically, because we're up in our investment to over $1 million, we have to put in another $250,000. And, but,
It's called a cram down?
cram down, yeah.
Like a shakedown.
Shakedown, it's horrible, right? And this is another thing. We had a lot of power in the beginning when we came, when I swagged up and said, we do $500,000, you know, up front. Well, now that's nothing. And now I'm an observer on the board, and the guy who's putting up all the money, rightfully so, is calling the shots. The one who has the gold rules, right? The golden rule. And basically, they're being nice because he's putting in another 3.5 of the 5 because he owns that much of the company, and it's a 5x preference. So at least that 225 we're going to put in, if the company doesn't sell for a lot of money, before everybody gets out, if they sell for $2.5 million, I will get $1 million of that out. You know, 5 times the 225. So that's where we're at. So this was a great opportunity to get a 100x return. It was tremendous. And guess what? So what do I think now about this company? I think it's still a great investment. I think they now have their Generation 2 product complete. They're doing sales, you know, not a lot, and Generation 3 is coming soon. Generation 3 is going to allow for you to do video surveillance anywhere in the world and get it fed back to anywhere in the world you want. and it's really good. They have significant orders. American Airlines Stadium has it, a number of stadiums. They've got energy companies doing it, and universities. A lot of it's being weighted for the next generation. They have partners in there. Even some of the channel partners are on their board now. Sales projections of $200 million looks realistic. There are huge multiples in the video industry. The moral of the story is early stage, more risk, more time, more money is going to be needed, and you need time to survive. They got lucky and we got lucky because money came into the company. And that's the pattern you'll see in our investments. I think we have a really great portfolio. I think the investments we made in these companies are great. But the fact is, every one of them took longer than we expected. Staging Concepts. The Staging Concepts are a little different. This is a private equity deal. So staging is a stage. They make stages, and I met them through the private equity group, and we actually partnered with the private equity group to do a deal. And there's a leverage buyout. So this is a totally different thing. So I wanted to bring it up because our criteria went out the window when we saw this opportunity. We were an early stage, and now all of a sudden we had a company that did $26 million in sales, and we bought, $2 million in equity went in, 500 of ours. We owned 17% of the company, okay? We're the largest investor. And the good thing about being the largest investor in this deal, we were about to walk away because the owner kept 30% and we didn't know about it until the end, and we walked away. So we decided, okay, look, you let us participate with the management fee with you guys on the same terms, and we'll come in. That meant $100,000 a year in fees to us. So we got most of our money back already just in fees. We are now they even need a little bit more money. Their idea is you get the leverage buyout, you get a lot of debt, and you work out the debt over time, and then you resell it, getting new deals in. Anyway, what happened was now there's a great management team. Sales are up to $36 million. We're trying to buy out and do a recapitalization, buying out the owner and getting in new acquisitions. And, this is a Rust Belt kind of business. I don't expect a huge return on this. I thought it's less risk. This was an existing company that we knew that there was demand for the product, right? But feel pretty good about this, even though this took a long time. Interim Lender is a finance business, and we were able to make a deal by going in and investing. There's general partnership and limited partnership. We were able to make a deal by investing a lot of money in the limited partnership. For that, we got a kicker of a 30% or 40% ownership in the general partnership. So we became partners just by being in the limited partner where our liability was low. I should say this is a very interesting deal because they give interim loans to commercial lending. And these interim loans are backed by the SBA 504 program. There's a 60-day window where the SBA can't fund, so they put money in. And you think, boy, can they make it? Well, because of leveraging and the velocity of money, they're able to provide a 30% return on your money. And nobody would believe that could be, and nobody would invest. And I spent like 9 months reviewing this and working it out. And it turns out, that they promised that annual return. It was too good. Well, they did it. For the first 2 years, it was 30%. Then the business changed a little bit, and we're trying to recoup it. They're down to 8% now, but they're going up again. I don't want to take a lot of time on it because I want to give these guys time. But the problem this company had was in growth. We're part of the general partnership. We want to grow the business, right? Well, we're unable to grow it because the people, they need leverage, okay? They need a lot of money to leverage it. They need low-cost capital to do it. And these banks would not lend. We got about a $6 million line of credit. Couldn't get more. Trying to now, but because of the time that it's been in business and because of the strange nature of the business, it didn't fall into any of the buckets of a regular bank. It wasn't like receivable lending and stuff like that. So they had a rough time not having enough low-cost capital to leverage this whole thing. But we're getting very, very involved in this company now, and hopefully we can move it forward. And Ritter Pharmaceuticals, well, this is just a good story. Do we have time for a video? Okay. I'm going to show this video because you guys want to be entrepreneurs. Andrew Ritter went to the Tech Coast Angels and was in this quick pitch competition that you've all heard about, probably. And here is, I hope it works. I don't even know if we're set up for this now. Cannot find internet service. Okay. If we have time at the end, I will show the video. But he won the first prize at the Tech Coast Angel quick pitch competition, got all kinds of accolades. Nobody invested. You know, so he could take his trophy and whatever. So he had to go and get outside people. We came in later on. We invested. They are now going public, a small public offering, because they couldn't get if you guys in the healthcare field know that the pharmaceutical company, this kind of business, the biotech area is like entrepreneurship on steroids, because you need so much money to make. It costs $1 billion to bring a new drug to market. Okay, it's huge dollars, and they tried, as we're trying to do at Medicus, to bring the product to far enough along that pharmaceutical companies would partner with us and take it the rest of the way. And they got very close. They got a lot of interest, but it fell apart at the end, and they decided, because we have venture capitalists on our board, on Ritter, that we're going to go public, do a phase, it's called a phase 2B study, to really show some more things, and then we think we'll be in good shape. So raising $25 million at a $75 million valuation. We invested at a $20 million valuation. Question is that a good deal? I don't know. We're going to be sitting with that stock. We can't sell it right away, and then there's probably not a liquid market. So we'll have to just see how it goes. And then there's a paywall company we have that had projections of $400 million. $400 million they were going to be worth in a couple of years, right? Or was it sales? Or was it profit? Net revenue of $400 million in a couple of years. We're doing a couple of $1,000s a month now. We're just about at break even. We're just about at break even, and we're trying to sell the company. And this is because it says the names. I shouldn't have put the names. Jeff Tinsley, who is a very successful internet entrepreneur, mylife.com, he said he was going to sell the company and take over that company. So looking at the management, he was going to be there. He left this other guy in there. Don't look at them. And that we didn't like, and we wanted out, and it never happened, and the company never went anywhere. But a paywall solution on paper had a great potential. Media companies who were doing their advertising the regular way weren't getting enough money, and subscription-based advertising a lot better. So paywall pops up if you've looked at, if you've been on 10 minutes, or if you've gone onto a certain section 2 or 3 times, or whatever you set it for, you have to subscribe. So you get money that way. But a lot of these people were scared that they'd lose viewers. I don't know what they were scared of. They weren't getting any money from them anyway. But they were scared, and it took a lot more to get involved. Right now, we do have a few large publishers and looking to get out of the business. Sorry, see, I tried to get in too much. This is my portfolio. And now, for Charles and Anthony. Now we're still good, right? Are we good? Mm-hmm. I don't want to see.
I'm fast.
Look at him.
My
Look.
wife says.
Oh.
Right.
That was good.
How are you going to talk? Right. So Charles, alcoholic. No, I'm just kidding. So I'm the CEO, co-founder of MIQ, also known as Translogic. Anthony is my partner. We've been together for a long time in the payment space. That's our background. We've done electronic processing for businesses for a long time. And that's actually how this company that we're in now came about. We thought it up in a vacuum. It was actually interaction with customers from another tangential business. And one of the things that we found out and learned a few years ago was that most small businesses don't know who their customers are. You go in a sandwich shop, you buy a sandwich, you walk out. They don't know anything more about you than your credit card number. And so we also learned that most of those businesses wanted to learn more and get more information. And so we have spent the last couple of years trying to solve that for businesses, for specifically small and medium-sized businesses. And we came up with a proprietary process whereby we're able to take credit card transaction information, your credit card number, for example, and use that information to understand who the cardholder is in connection with those transactions, and then append all kinds of characteristics and attributes about those cardholders. And then we return that information to merchants, but we do it in an anonymized way. So we're not saying anything personally identifiable about those cardholders, so we're not kind of crossing the Google line, so to speak, that everybody's worried about. Rather, we're giving them enough information to say, and to kind of create their customer pyramid. Here's who my best customers are based on X, Y, and Z attributes. Information like how much money they make, whether they're married, they have kids, what their lifestyle and preferences are, how they go about making decisions, and where they live within some 7 households. So even that is kind of aggregated and anonymized. And so we make that information available online. So it's a SaaS model. It's an internet-based portal that the merchants access. There's a basic version for the kind of mom and pop, blends some information with some marketing capabilities and some managed services. And then there's an enterprise solution for multi-location businesses. Merchants are using that information for all kinds of things, specifically marketing-related decisioning and activities, but also things like where they may want to open a new location and how they go about thinking about that and evaluating site locations, for example, or operational decisions like hours of operation and price inventory mix and that kind of stuff. You have a question?
Yeah, can you please clarify how you get the inputs of these data? Just any legal constraints there?
Yeah, so I'm going to get to that in 1 second. Because what's interesting and unique about our company is that we solve 2 problems. We solve one problem, you saw Professor Nathanson's, what pain are you solving? So we're helping small businesses understand their customers, whereas they otherwise wouldn't be able to. But then being in the electronic payment space and having that background, we identified another problem that we could solve and gain distribution at the same time. And that is credit card processing companies themselves access a large number of merchants across the country, but those companies are otherwise undifferentiated and commoditized. And so we partner with those companies. They're actually our customers. We don't sell to merchants directly today. Rather, we partner with these intermediary distribution channels. They license our technology, private label it, and then make it available to the merchants. In doing that, they share with us the transaction-related data. We then use that data to run our processes. We access a number of third-party data repositories, syndicated data to do all of the things that we do, and then we make that information available to the merchants. And so that's been, that was the primary kind of go-to-market business plan, if you will. That the thinking is and was, it would cost a whole lot of money to go out there and sign up one merchant at a time. And it would take a long time. Or we would have to sell this product at an extremely high price point. So for your edification today, this product is delivered to merchants in the tens of dollars per month range. Right? So extremely reasonable, especially when you compare it to, it would cost me $10,000 to go do a survey to find out one time generally who I think my customers are if I'm a merchant. Right? Cost prohibitive for most businesses. And so the conventional wisdom was and is that by leveraging these intermediary distributors that we can get scale rapidly, so they can turn on a large number of merchants. And so that has happened. We've been able to go in 2014 from essentially 0 sales to bringing on around 50,000 merchants in a very short period of time. And so we are scaling now with the credit card processing companies. It's taken a long time for us because of the sales cycle, much longer than we anticipated, especially because we're doing a kind of a top-down selling strategy, so we're not talking to all the small guys out there, we're talking to the bigger, larger credit card processing companies out there. And so in some cases, those sales cycles are more than a year and a half long. By the time you cover due diligence and regulatory issues and contracting and commercialization and all of the things that need to take place. And so, and I'll kind of open it up to some questions because I know we're running out of time. It took us a lot longer than we thought it was going to take. We've raised around $3 million to date, which is not a lot of money to build a product and go to market. But that's because we were able to leverage the intermediary distribution, right? So barring that, you know, we need to go out, we need to raise 20, 30, 40, 50 million dollars to go to market and spend a lot of money to go out there and sign up one customer at a time. The flip side to that coin is we are now beholden, right? So we're beholden to the time frames and the issues associated with relying on an intermediary between us and our customers. So we're contemplating what that may mean for us going forward. We're considering augmenting our strategy with a direct-to-merchant strategy and raising more money. But we've raised about $3 million over the course of a couple of tranches, essentially. Three tranches. We had a $500,000 seed round, and then we did another $1 million or so, and then we've done another $1.5 million, and we're raising another $4 million right now. We've avoided venture capital. To date, I don't consider, from an entrepreneur's perspective, I don't consider Dan's company a venture capital firm. I consider it a family office, right? So there's all different types of, you know, opportunities out there to raise money. So we focused on high net worth individuals and family offices. And the reason is because we want to retain, we're pretty optimistic about our prospects going forward. We want to retain as much of the company as we can as management, get as far along in that progressive storyline as we can before we have an event or we raise money from institutional investors where it's going to be a lot more costly if we don't have a great deal of track record and proof of concept and revenues and that kind of stuff. So right now we're kind of at that critical inflection point where we're just about to break even and we're going to start growing, and so now it's how do we contemplate managing growth going forward. Question? Yeah.
Yeah, so I was wondering, your intermediate distributors, do they also help you handle like account management, setup, retention, and so on? Because like you're spending, like you're not spending that much to get these customers,
Yeah.
but your retention's kind of.
We are, but they're not very good at it, right? So these credit card processing companies are okay at taxing merchants, but they're not great at cross-selling value propositions. So we get at large numbers of merchants with high attrition unless and until we engage and start to help them to sell through. So yeah, there's an incremental cost that we're starting to uncover as we progress, certainly.
Could you talk a little bit about some of the data sources you're pulling from? Like, where do you get the income data tied directly back to a credit card? You know, how is that available?
Yeah, so I'll talk a little bit about it. But essentially, what we're doing is we're using the card data to identify the customer, and then we're going out and we have licenses with, you know, various syndicated data repositories that you'd be familiar with, the credit bureaus, for example, and Dun & Bradstreet's and those kinds of companies, where we're pulling in characteristics and attributes that match to that card holder, so to speak. And then what happens is we take that and we segment those merchants into one of 70 cohort groups or segments. And then what we're returning back to the merchant is this transaction was associated to this cohort group. And that cohort group has certain characteristics and attributes associated to it. We've also done some one-to-one stuff with loyalty as well, but in the case where there's authorization, to your point, to your question, on the cardholder side to use and share their information, then we can come back and we can assign and append characteristics and attributes to that individual, which can then be used for one-to-one marketing. Otherwise, what we're delivering is referred to as kind of a one-to-many basis, right?
Is there any like fact to prove that using your service literally help those merchant?
Yeah, great question. So that was a big question early on. We had very little of it. We're starting to get it now. So yeah, so both the biggest use cases, and we're starting to get a number of examples and statistics, but the biggest use cases are specifically direct marketing. You know, merchants coming to learn empirically who their customer is. Oftentimes they're wrong, interestingly enough, especially the small merchants. You know, the comic book store owner's customers, he found out, are older and more affluent than he thought. And so now I can go and I can engage in a direct mail campaign by list or do direct marketing activities or social activities based on that information. And so we're seeing stuff like, you know, small businesses having, you know, $40,000, $50,000 a year-over-year increase. We're seeing, you know, 116% increase in targeted geographies month over month for small businesses, right? Identifying underserved adjacent geographies, that kind of stuff. And then site location. So we're starting to find out that there's a lot of multi-location businesses in the kind of 50 location range that are really struggling with thinking about how they're going to expand. They're taking on private equity money, they need to grow quickly, but where are they going to open up all these locations? And so literally some of these companies, they've got 50 locations and they're doing this. I think my customers, you know, have $100,000 a year in annual income. So let me get a census data and a heat map and overlay that and try to figure that out. Well, that's only so effective, right? So now they can start to understand at a much deeper level, based on their own actual transaction data, who their customers are and where there are other like pockets of customers.
Okay, so,
Yep.
well, I want to give Jorge some time, and then we're going to have a panel discussion right after that, so.
Okay.
Yep, there's a, that's what
Okay, can I put it on now?
Yeah, we have sound?
I hope so.
Right. So I need to input a password, unless you're ready to go. Yeah. So, this is what I thought Derelicious was going to be, right around the time I met Dan.
you showed this in my class.
This was my final presentation, yes.
So the bar is high.
It's coming from here.
Stan is the man. How did Stan become the man?
How did you become the man? Stan.
Well,
Come on, Stan, it was awesome. Come on, Stan, it was awesome.
go.
I dare you.
No.
How about now? 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 How about now?
Stan took his first step toward becoming the man by taking on a dare at Darelicious.com. Darelicious is the exciting new website where you can challenge your friends, complete strangers, and even celebrities, all while earning money for you, your charity, or your favorite dog. How did I become the man? Well, she dared me to do the full man chew, and now thanks to Darelicious, we're all winners! Dairelicious, turning your dares into dollars. For you, your charity, or your favorite cause.
So keep that for you in mind real quick. So real quickly, my name is Jorge Hernandez. Only because of, only because a lot of people have a hard time with my first name. Think of it as two words. Think of it as poor and hey, and just put them together really quickly. Jorge. Just no hey. So anyway, so I'll get back to, I obviously gave you a little quick one-line description when Dan put me on the spot, and you saw the video. You got it? Okay. So,
My job as a VC.
So what happened, I started, I was, actually I should say I'm a FEMBA. I graduated in 2012, and while I was there, I came from the entertainment business, from the music business, and I got really interested in crowdfunding. Obviously, right away knew I didn't want to try to do it on Kickstarter and Indiegogo because that ship would sail as far as I was concerned in terms of bootstrapping a business. There needed to be something a little different. So that was sort of in the air. I was at an EA meeting, a lot of you from the EA. So I was at, I just happened to pop by an EA meeting, and I think you guys all know that when they deliver pizza there, they deliver about 10 times more red pepper than meat pizza. And so a buddy of mine was like, hey man, can you just help me clean this up? He was hosting the thing. I said, sure. Well, a bunch of us hung out, and one of the guys, a real wise guy, he said, hey Jorge, I'll actually censor what he really said, but he said, hey Jorge, here's a packet of red pepper, how much would I have to pay you to snort this, right? And then he said, I'll give you 20 bucks. Somebody else says, I'll give you 20 bucks. And it just got really humorous, and then they got more creative of what I could do with the red pepper. I won't go there. But anyway, the point being is that this sort of like crowdfunding in real time sort of happened there, right? And honestly, it didn't sort of hit me in the face right away. I just kind of thought it was fun. Something I did think of before as far as the crowdfunding was concerned was I wanted to do something where you didn't have to teach a behavior, because that to me equated into money. So like if you need to teach your consumers about a new behavior, that's going to take time, it's going to take money. So I had crowdfunding, I had that in mind. And by the time I got to my car, that's when it's sort of that eureka moment started to happen, which is like, well, wait a minute. You don't have to explain a dare to anybody, right? A little old lady knows what a dare is. You know, my 4-year-old daughter knows what a dare is by that point. It's pretty universal, it's ubiquitous. So that was sort of like, I still didn't think like, okay, can we actually crowdfund this in a way? Is there some way to do this? Because my initial thought was, well, these things are like what I came later to call one-to-one dares. I.e., you're in a bar and somebody says, hey, here's a red pepper, eat this and I'll give you 20 bucks, right? You're not going to run to the internet and put that on there. That's just not going to work. Why would you do that? It's instantaneous. So that was sort of my initial thought. But I kept working through this and I thought, okay, well, there's definitely a space out there where people, I saw instances of this on Facebook, or just people doing activities like this, very similar to this. And around that time, I also recognized, okay, I come from the music business. I have this great MBA education that I'm nearing completion, but I'm not in the internet space. So I partnered with somebody who was a good friend of mine, who I had a lot of respect for, who started an internet company in his bedroom, built that up to a sizable business. Actually, it was a great business. He left and he went on to do something else. Thought I left in good hands and we could put. But the point being was he had a lot of experience in this field, and I thought, let me get him on board. And I was thought, okay, I don't come from computer science, let me get somebody else there. So I had a founding team, which was myself, this person who had a very strong marketing background in e-commerce, and then the web team. And once we started working, I found out I wouldn't say very quickly, but I found out over time, okay, this web team is not holding up their end of it. They're working on this prototype that's kind of clunky. It's really, they're missing, you know, they're missing the schedule completely. My marketing guy was just spread too thin. And right on the time I was in business plan development, and I think a lot of entrepreneurs hate when I talk about this, but I wasn't looking for money. It actually found me. And I'll tell you what I mean by that. When I came into BPD, I was not looking for money. My head was sort of like, this is a great opportunity to use my education to do a business plan, which I would highly, I think Dan said he suggested. I just want to give a quick little caveat. Definitely, even if you're not taking BPD, do it because the exercise is really worthwhile in terms of really knowing what your business is and finding out what you don't know. And even if your financials are fantasy, which they typically are for early stage companies, it at least gets you to think of how you can get to that and what it takes to get to that. Those are really important things to know early on. I think all of us that are entrepreneurs, we fall in love with our ideas and we start drinking our own Kool-Aid pretty quickly, and we kind of ride on that fantasy that'll get us through. But even doing it where you don't have any realistic basis for your projections, some really like cold, sober reality starts setting in. So I would completely suggest you doing that if you're not already taking VPE. But anyway, getting back to, I was in dance class, and of course was working through it. A fellow student of mine, we were just in the lounge, and he said, "Hey, what are you working on?" I said, "I'm a business side development. I have this idea, this startup I'm working on." I didn't think much of it. I just gave him a quick pitch. I showed him my prototype and everything, and just left it at that. And then around that time, Dan as well, we were having conversations about just the project in general, strictly an academic level. About a week later, my friend said, "Hey, I really want to invest in this." I said, "I really hadn't thought about money yet." He goes, I wanted to be $100,000. And I thought, okay, that sounds, I mean, honestly, I was like, okay, I thought of it, but cool, that sounds great. And then, like, days after that, when I had one of my sort of tune-up calls with Dan in the class, he goes, "Hey, have you thought of raising money for this?" And I said, "Not really." He goes, "Well, I think this is really cool. I think we can really help you." And he told me about the firm. He goes, "Has anybody offered money?" I said, "Well, one other person." He said, "Well, I don't think you'll need him. I think we can do this." I just want to fast forward, though. That sounds great, right? It sounds like everybody just did this. From that point to actually getting checks was 6 months. And in that 6 months was, I would consider it pretty, I don't want to use a negative word. But let me say it was extensive, a lot of extensive PowerPoints, a lot of, "Hey, can you do a different market analysis? Can you do this?" Basically having me look at this business from every angle, and they both did in their own way. With Mike, who was a friend of mine, we had countless lunches where every time at the end of the lunch it kind of felt like, oh, he's not going to do this now, just because he basically put forth a lot of things that, frankly, I hadn't thought about to that point. And Dan, in his own way, of course, basically Dan was a lot more documented, but it took a long time to get to that point. And I think that's obviously natural with any, in my case with my friend, he knew me well at that point, he knew my background, we had spent a lot of time, so it wasn't an issue of credibility, but it was an issue of like, maybe I really want to give this guy $100,000 for this business. And I, like everybody else, when I thought, my first round with Dan was, I said, well, I don't think I'm going to need a lot of money, so let's just do 100, and we kept my other friend in, so it's 200, I thought. That one kept me to break even, right? Which is kind of hilarious, because it's definitely not the case. But what I found out real quickly was I had to fire my team right around the time we were getting funded. So that was a lot of fun. So I got rid of the web guys first, because I knew this thing was never going to get built right. And I had a sobering conversation with my wife, who is in the tech space. He's like, "I see this all the time. I've seen this movie, I know where it ends. We're not building a site." So fired them, got them to go away kept Dan and everybody else out of it, but myself and the other guy wrote a check to them out of our own pocket for that, just to keep this clean and not jeopardize the funding. So they go away. Not a lot of money, but still, it was out of our pocket. And then the other guy basically had this sort of proverbial come to Jesus meeting, like, "Hey man, if you're really going to be a part of this, I need you to be a part of this." 4 months later, I didn't hear from him. We're already funded at that point. Once we launched, I just want to give you a quick sort of rundown of what happened and then where we're at right now. So the idea for the company really was for people to use this as a self-serve model, and we initially set up the site. This is kind of a funny counterintuitive thing, what I'm about to conclude with, but I'll give you the first part, which was I basically wanted to make it as simple as humanly possible to use, because I didn't want there to be a lot of friction. I wanted people to be able to come in, use it, and not feel like they were just going to jump off the site because it was too difficult. And what I found out very early was that it was too simple to use. Basically, people were doing the absolute minimum for these campaigns, and a lot of them. So the site was being populated with a lot of very just ridiculous kind of dares where people were like, it was sort of like the, if I build it, they will come type of thing. So people putting up ridiculous dares and saying, "I want to raise, $50,000. And they thought they were going to get it for themselves. But they had no content, no anything. They weren't marketing it. So we learned pretty quickly, like, okay, we actually do need some friction in here to sort of weed out those people that aren't serious about this. And as we kept looking at more like sort of that self-service model for this, we realized, there's not a business in there for us because A, we haven't set up the culture of what this site is and what these campaigns are supposed to look like, and B, they're just not successful. Like, we need to be active partners. So we completely made a pivot in that we thought, okay, let's go out and find quality campaigns that raise bigger chunks of money so that we can actually, A, find a way to survive, and B, populate the site with the kind of campaign, the kind of campaigns, the kind of content that we do want to represent our company. And so that was a really big pivot, because again, we went from thinking people would just use the site on their own, which we still have people do that now and again, but we went out and actively became a partner. And what that also meant was, okay, well, we need to sell this to people who are invested in raising a lot of money, who are going to take their campaign seriously. So we've lost the whole, that's why I said, you know, it used to be turning your dares into dollars for you, your favorite charity or cause. We lost the you. Like, we don't service you anymore. It's all about your favorite charity or cause. We go out and we look for these either organizations or individual causes or people with foundations that want to do something a little bit different, a little bit sort of off the wall to differentiate themselves. One of our pitches to anybody that's in this space is like, look, how do you sell your nonprofit? And they all say the same thing. Well, we're a noble cause. We're a great cause. I said, well, that's great. Guess what? Everyone else is a noble cause. Everyone else has a great cause. That's not a differentiator, right? This allows you to do something that's just a little funny, a little quirky, and it allows you to differentiate yourself from every other campaign that you're doing with a lot less time and effort in, which has borne out. So here's where we're at now as a company. We really, I don't know why I think there's a slide there. So we've come to the point where we feel like, okay, we've got a handle on what works on our site really well. We've identified the attributes. We feel really good about the process. But and to Dan's point, it's like time. Time is the big, for us, is the big enemy, because we need to maximize the time we have left, the runway we have left, to get more campaigns on the site. So the last conversation I had with Dan about this was, it's kind of funny, a lot of businesses have their multifacets to their sort of continued growth and success. Ours is pretty simple. It's one thing. We need to get more campaigns on the site of the nature that we're doing. And so here's the sort of the funny part is, the pitch is easy. Like, we do the pitch, everyone loves it. The initial pitch is super easy. For us, the big challenge now is the sales cycle. Like, from that initial pitch to getting something on the site takes a long time. So where we're at right now is, okay, what we need to do, we can't seem to fight that, because there are variables that are out of our control that frankly influence that. So where we are now as a company is, we need to actually then just increase the number of these leads, so that eventually we have just a good flow of campaigns going through the site without having to worry that, you know, 1 month we'll not have enough to basically keep the company alive.
So you want to show them what a dare looks like now?
Oh yeah. So let me just show you that real quickly. Where's the slide? Oh, right. Can you tell me what slide is? Is that it?
No, but this is the PowerPoint right behind it.
Oh, this one? You just hit that? Okay. So this is Darelicious now. We had an update last night, so I was a little nervous. I'm like, oh my god, I'm going to open it up and it's not going to be done. So basically up here, we add anything that we're really kind of pumping and we're really excited about, we put up here. So this is one of the newer campaigns. I'm sorry, I'm a PC, guys. Hold on, let me just pull this up. Okay, let me go here. Just do that. So basically, we don't have to look at the video, but there is a video there. I don't know why it's not popping up there. Here. Okay, so this is an intro video. For those of you who use other crowdfunding sites, we obviously model a lot on what exists. The reason for that being, we just felt like, why are we going to reinvent the wheel? This is what people are used to using. How do I scroll down that? I don't see it. Oh, okay, cool. Sorry, again, PC, sorry, people. Anyway, about section, we have, there are incentives, so it's very similar in terms of how it's laid out. And again, what?
You're going to show the video?
Oh, I was going to say, no, it might take too much time. Yeah, but anyway, you get the flavor for it. So these are some of our, here's the interesting thing we found out. Like, once we, just to give you an idea of what learnings can do for you, we had a celebrity on the site, a comedian named Ron White, with a lot of social influence. I mean, a ton of social influence. His campaign raised about $5,500 for us. And there were a lot of sort of crystallized things that occurred as a result of that. And then these two campaigns came on after that. And based on those learnings, you can see what the multiple is in terms of the success of these campaigns. And a lot of that really was just us changing some of our, internal thinking. And frankly, these are the kind of campaigns you want to keep on the site now. This is, for instance, a self-serve one. This is somebody that a student did this last year. They did a great job as a self-serve, but you can see this is not going to keep the lights on. It's a $500 bill, but at the same time, it costs us nothing. Like literally, we're doing nothing for it, so the marginal cost for that is like next to nothing. That's really it.
Okay, good.
Just wanted to tell you about Medicus, and then we'll have a Q&A. Medicus is a PEG-based polymer, polyethylene glycol-based polymer, that goes from a liquid to a solid and gels up and can deliver all kinds of drugs and APIs. And we started basically, the initial idea of the company was to cure lung cancer. And we basically, instead of having the regular chemotherapy, we took our polymer with carboplatinum, which is the drug for chemotherapy, mixed them up, put them into the lung of a rabbit through a bronchoscope, and our polymer gelled in the lung and then eluted or released the polymer over time. And we could put 70 times as much carboplatinum than you could do systemically with all the side effects that you get from chemotherapy. You wouldn't get them with our polymer because it stayed localized in the space. We quickly realized that we proved something, and that we could probably go in and prove that we could reduce a tumor for another $50,000. We started with like $500,000 again, and we could reduce a tumor and then say, well, let's say we do that test and we find out that we can reduce a tumor. What happens then? Then do we have to spend $20 million in order to get it to human trials and go through the FDA regulation and all of that? We basically dropped the idea and said, what could we do? And about the same time, and by the way, so we have all these applications that this polymer can be used on: oncology, ophthalmology, surgeries, orthopedics, anything. We can deliver stem cells, we found. We could have them remain viable within our polymer, and we can also have them proliferate at the site of the disease, which is a big thing. And so basically, and there are a lot of great characteristics about our polymer. Gel time, degradation time, we can adjust all these, the viscosity, the pore size, the adhesion strength, the hardness, and the way it releases from, the drug releases from there. And so we can deliver antibiotics, stem cells, proteins, corticosteroids, antiseptics, all these kinds of things. So what do we do? Okay, so it's great we can do it all. How do we get this to market? Okay, so as I said, we started with lung cancer. Then luckily, our advisor, and we didn't talk about advisory groups or anything like that, our chief scientific advisor, who was a general surgeon and head of the biomedical engineering department at UCLA, got us involved with somebody who's at the Jules Stein Institute, who got us involved with the Eye Institute, and we now are testing with one of our with the biggest eye ophthalmology company. We're testing for a patch, a retinal patch, without drugs, just to use our polymer to repair detached retinas. And that's kind of a big thing, so we're really excited about that. But we didn't know where to go, so at the same time we were doing that, we said, one of my friends had a dog who they spent $8,000 on for a hip replacement or some hip surgery or something. I said, man, there's a lot of money in those dogs, you know? So, so we got a dog business. We went into veterinary medicine. We now are selling, to keep the doors open, a suture seal. It's a liquid bandage, and it heals better than a bandage. And a number of veterinary companies are now starting to do away with the bandages for a large part and keep this on. You put it on, it just stays on for 2 weeks and then automatically dissolves or degrades. So we have that, and we also have been injecting our polymer with corticosteroids for a syndrome called navicular syndrome in horses and other applications. And the problem still, even in the veterinary space, is regulation and whether or not we're considered a drug or not. And these things, even in the veterinary space, to get into it, costs $5 million to get a drug, $5 million in maybe 5 years. So we're trying to see if we can sell our Suture Seal as just Suture Seal, as not make any claims, and therefore be not part of this regulatory thing. So the vets can act as compounding pharmacists, which they do a lot. They're allowed to mix, they can mix our drugs with our polymer. So if we could let them know, oh, by the way, studies have shown and people have shown that if you mix it with XYZ, it would really be good. And now the thing we're looking at is otitis right now, which is an ear infections for dogs, and it's a major thing. So we're doing that now, and we're trying to make all kinds of business development deals with not the biggest pharmaceutical companies in the world, but as secondary or with compounding pharmacists and such like that. So that's where we're headed with our product, and it looks like it's starting to work pretty well. And my final thing was to sum up this and show you how much money we thought we were going to put in, how much money they needed, how much time, and that we need a lot more time and a lot more money. So that's it. And I just wanted to, I don't know how to turn this off, so I won't. But I wanted to, say that one of the things I talked to Andrew Upchurch about was the availability of internships, and we need interns in SJIC, we need interns in Medicus, and these guys need interns as well. So maybe we can talk a little bit about what your needs are, if they're defined, if they're not. It's really, getting interns is not an easy thing for companies, right? Sometimes it takes more time than it's worth. So there really has to be a good fit, and you really have to be committed if you want to do it. But I'll tell you, working in a small entrepreneurial environment, or a VC fund, or you can really get to see a lot about how business works. So I recommend it. But do you guys want to say anything about your needs?
Sure. So Anthony, Charles is here with me, so I'll be taking him out of here at the end of this. It's foul language, but
bringing him home to his wife.
Exactly.
Get plenty of time.
As Charles kind of mentioned in his talk, there's really 2 interns that we would look for right now. So one of those would be in taking our services direct to merchant, testing out sales strategies, developing marketing materials and things like that to go along with that effort. That's going to be kind of a new ground for us, although Charles and I both have a lot of experience there. We're focused much more on kind of big picture things, and so there's an opportunity to take a lot of ownership over that, but at the same time get a lot of great oversight in that process. And so that's kind of one track for interns. And then the other track for interns is we have a lot of data that we have accumulated now in our working with thousands, tens of thousands of merchants. And we're kind of only scratching the surface of what we can do with that. So there's a lot of opportunities there to do data analysis, to do additional product development, to come up with kind of new insights that we can deliver back to merchants and create more value for them. And so kind of the data analysis and product development would be the other track. So that's what we're looking for.
Right. And you know what we'll do? We'll send out some emails about it.
Obviously, Dan has all of our contact info.
We'll work it through Andrew.
So for us, we really at this point have to just do one thing and do that well, and that's our sales function more than anything. And so there's 2 of us at Delicious that work full time. We outsource for everything else. Our web team's outsourced, everything else. And for me, just running the company, there's always things I call them like they kind of frustrate me when I have to do them because they're things that I know do not move the needle, but when you're running a company, you need to happen. So that there's definitely a void in terms of having a bigger sales force. And the way we do that, there's actually a project management component within it, so it's not just you selling something and then handing it off. It really is, it's integral to what we do. So if anybody that was interested in coming to work as an intern with us, you would be moving the needle for us. Like the kind of things you would be doing are actually integral to our continued success and our growth. And it definitely falls in the categories of sourcing new campaigns, and that could be from your own network, or you could come to us. I mean, it's wide open and say, okay, we see the areas that you guys are looking into. Have you thought of X, Y, and Z? And then creating a strategy to get into that, to get into that particular vertical as well. That's really it.
Yeah, I think that any position in any of these firms will give you a strategic oversight of the company, what they're trying to do, and whether it's doing some grunt work, but even sales will give you a real understanding of customer needs and bringing it back. At Medicus, we really need, especially if you have a healthcare background, we'd love to, we are now building up we're selling to the market, to the veterinary market, but we're also getting in salesmen / business development people. And we have a lot of need for discovering opportunities for our channel and to work with our channel. And for SJIC, there's always things around. I don't have anything on the top of my mind right now, but doing an analysis of the, like what I showed you here. I got this together and I said, how much did we invest in Ritter? What was our terms? So helping us put together our reporting and working with our portfolio companies would be beneficial. So yeah. So maybe we'll have a few minutes to mill around afterwards. I don't know if they're going to kick us out. Ryan, are we going to be kicked? Heidi, are we going to be kicked out here? No. Okay. So good. Have a little bit of time to talk. I don't know if you have any needs for cheap labor.
Probably not so much in the law firm, but maybe some of the companies that are pretty seller here might. So.
Oh, good. Yeah, that's good. Good idea.
Okay. And so what I kind of reversed the order a little bit, but I certainly talked for a while. These guys talked a little bit. They have real interesting organizations. If you have any questions that came up from there, I know it's hard to think back about what we said, but do we have any? We can do a Q&A session now.
Yes. For Ritter, you said they won the fast pitch competition, and they seem to have a lot of. They seem to be investment. Like, how come they never got a lot of investment?
They did get a lot of investment. There's probably $20 million invested so far in Ritter. Our ownership is about 3% of Ritter we have $1 million in there. We have about a 3% ownership. They did get investment, and what they got it from wealthy individuals and a venture fund. And in fact, the venture fund, in order to go public, Ritter needed about $3 or $4 million to just get the process rolling and move it forward. And the venture capital firm is putting up the money for them to do it, which is diluting my interest, but at least they're alive. And now they're doing it. But it's very difficult to get money for these healthcare firms because of the reluctance of the big pharma, So you have to, I don't know, for those of you who don't know the healthcare field, you've got to do animal testing. You've got to go through the FDA regulatory process. You need to go through phase 1 clinical trials, which is safety. You have to, for in humans, you've got to go through phase 2, which is efficacy. Then there's phase 3 and even phase 4, and it costs a lot of money to do these tests and to run it through the regulations. So That's the big problem with it. And there's all kinds of different, if you're a device, you have less stringent requirements. If you are a drug, classified as a drug, you have more, and it gets very complicated. But they did raise some money.
The other thing is, it's been my experience, I know other entrepreneurs, this is from the entrepreneur side. Tech Coast and Pasadena Angels, it's very difficult, and it takes a lot of work to get people there to actually write checks. Checks of any real substance or meaning, for what it's worth. That's been my experience. Maybe other people have different experiences. I know you're involved, but it's a long, drawn-out process. It's decision by committee. Unless one, wealthy individual decides he wants to step up and do something, it's challenging.
I was an intern at TCA Tech Coast Angels my first year at Anderson, and I agree with that. That was kind of my takeaway from that process of wow, it takes a long time to get a check written here for any size.
It's good in theory and concept, but in practice it doesn't seem
Well, they were trying to react to that. I don't know how successful they've been, but they said they now have a 30-day process that they put in place. You could check it out. Yeah.
I have a question for Delicious. I really like that idea, really fun and creative. But how do you identify your audience and how do you reach them?
It's a great question. So our audience right now, more than anything, are people that would put up campaigns that have a readily identifiable network of people that they can engage to actually participate in the campaign. So that right now is essentially nonprofits, foundations, and individuals that have, again, they have a lot of influence that are interested in that space. So we've done, believe it or not, we've done a lot of cold calling. We've had a lot of success with that of just getting directories for these different customers that we've identified, and a lot of networking. So, for instance, I come from the entertainment business, so I went to agencies and went to, each one of these agencies has and I wouldn't call him an agent, but an executive that's kind of in charge of overseeing the philanthropy. So anybody in the philanthropic world, I'm always about talking to them because I told them about the idea and they always have some suggestions. So it's been a lot of networking, a lot of cold calling. And then, of course, using warm leads. So, for instance, the Jump for Jude campaign, which has been one of our most successful to date, that's actually Dan's daughter that's in that campaign. So, Dan was actually one of the very first campaigns. Dan used to have a mustache. He used to have a mustache, and no one had seen him without a mustache for like 40 years.
$600 from you.
I got $5 on you going bald.
Yeah. I had a question for MIQ. You said you guys have a lot of information on your customers. What's your next customer? Who are you guys going to be going after directly?
So we now have identified those merchant segments that are kind of the low-hanging fruit, which include retailers and restaurants, hospitality, grocery, internet retailers, health services, and anyone that has multiple locations that's B2C. But specifically, really, the retailers and the restaurants.
So physical locations, mostly.
Yeah, right. And then omni-channel, understanding, how your customers vary, whether it's in a retail, brick-and-mortar, mobile environment, or those that are coming from the internet. The other thing that's really interesting that we're doing, too, as we start to think about and contemplate going direct to merchant, is integrating those other data sources. So now, not just understanding who your customers are and where they're coming from, but what did they purchase, and how does that relate to the storyline? More holistic need for merchants.
I just want to say both of these guys, both of these companies are probably more online than most of ours. Took longer, but the thesis that they had, that the ISOs, the channel, would bring them the customers and that it would be of value to the channel, worked. Now the question is a whole nother kind of game. Okay, we're in there, let's keep it. How are we going to keep it? And that direct channel, direct approach is a whole new business model, basically. one that they have experience with, so which is good. And with Darelicious, we tweaked it, I think, from a crowdfunding thing. It's still crowdfunding, but more like a fundraising, a tool for traditional fundraising. And perhaps we will go back full circle when we keep on getting people, more and more people to the site, and they start to move it along.
Can you talk about, I guess for the entire group, just about the back end, about exit opportunities, and how, I guess, the conversations between SJ and your companies, like how you go about it, what happens when if you guys don't see eye to eye on that?
On what the exit strategy is?
Yeah.
Personally, I think that there's probably got to be alignment up front in terms of what the exit strategy is, and what we think the expected time frames and multiples are. In our case, I think that we'll end up with a number of opportunities to include an IPO, although I don't think that that's a direction that we'll end up going. And hopefully we'll get an offer that's too good to pass up from probably a strategic or a financial before then. Financial, like a private equity group, once we can kind of get to the growth stage. Ideally, we take some chips off the table and then stay in and kind of go to the next level. But I know these guys, their objective as a VC is to get tenfold, 10x return on their money in 5 to 7 years, and if you can have it in 4 or 5, then that's ideal. Right? So we're kind of 2-3 years in and kind of trending.
Yeah, I just want to expand on what he said. I think the whole process of getting anybody to invest money in you, that is, unless it's like the 3 F's, the friends, families, and fools. Outside of that, if you have any smart money investing in you, everything is laid out there. I mean, by that point, you guys, both sides know each other really well and the expectations, and that's sort of one of the first things you put out there is, obviously from Dan's perspective, if I come and I was like, I want to build a sustainable business that I could be running for 20 years, it would have been like, bye, see you, because that's just not the business he's in, right? And so that alignment needs to happen pretty early on before you even get to even more what I would call intensive kind of due diligence. I think that's one of the first things that needs to happen.
Yeah, well, it makes a real difference to us how much equity we own in the company. So we're more partners with Darelicious in that sense. So we don't need as big we have more of an equity stake, and we're the only investor in there. There's one other person in there, so we're just one of many now and will be even more so in a little bit as we get more money in. So we need a bigger hit, obviously, to make our same return. So our exit amount for Darelicious that we'd be satisfied with is lower than for the other company. So, yeah.
Oh, my question was very much in line with Ryan's about exit strategy and what that typically looks like. So it was answered.
Yes. For Darelicious, you mentioned that alluded briefly to a campaign that Ron White was involved in. Could you elaborate a little bit more on some of the celebrity engagement you talked about with Darelicious?
So Ron is, if you guys don't know, it's really funny. Ron is one of those guys where you say his name, and a lot of people are like, yeah, I don't know what you're talking about. Then I say the Blue Collar Comedy Tour, which was Jeff Foxworthy, Larry the Cable Guy. They're like, well, he's the guy with the Scotch glass and cigar, and everybody's like, okay, I get it. So Ron has a lot of. Do you want to know specifically about the celebrity engagement, how that happened, or that campaign?
Well, just in general, because I think one of the things I was reading in the PDF that went out earlier, it sounds like that's a part of what.
That's part, yeah. So that's sort of a twofold thing for us, obviously, and it's a little bit of a. I'm actually glad you brought this up because it speaks a little bit to a pivot that we had. So when we came into this, we looked at influence pretty much from the perspective, and that's a very important in our role. When I mean by influence, it's like who can actually bring people to these campaigns, right? That's how we had it to start with. We just thought of it broadly like that. So being an MBA student, it's like, how do we quantify that? Oh, we look at Twitter, we look at Facebook, we look at Instagram, we look at all that, right? And then what we came to find out is that influence is far more than a metric because that speaks to how many people have chosen to just either like that or to follow. But that doesn't actually speak to how willing are those people to act on that person's behalf. So how can I make you, like if I follow you, actually the other way around, if I follow you, how much do I value you enough that you can compel me to act? And that is something that we learned in that campaign pretty quickly, like, okay, huge metric, but does it have the same stickiness in terms of making people, compelling people to act in this forum as other campaigns that we've had? So we've kind of rethought, and we had, I don't want to mention the person's name just because it was so, it really hammered this idea home like on such a level, but we had another, I would say about equal stature celebrity, who, again, it's not on the site, so I don't think you'll find him. But anyway, this was really hammered home because he came on the site, great social media following, and released $25. And so it was really obvious, like, in his social media, those numbers were real. They weren't like he bought those numbers. But again, this whole idea for us now, we identify influence very differently now. We just don't, that number's great. But we also look at a lot of other things, like for instance on Twitter, how much are they retweeting, how much they get retweeted, how much are they favorited, things of that nature. What other things, if they are endorsed, if they endorse anything, how well do those lines do as a result? How do we can gauge that? But essentially that's something we've looked at that we've changed on the celebrity space, because before I think we were just like a little starstruck, like, oh great, it's a celebrity, let's do it. And what we found is, yeah, that reach is, it's a little bit more complicated than just the fact that they are a celebrity.
I don't think you could figure this stuff out until you are in the business.
That's exactly.
And this is like the lean startup or testing it. You can make all the assumptions you want and on paper, but until you're out there testing it in the real market, you don't know.
Yeah, I totally agree.
Anybody? Any other question? Yes.
Can you talk a little bit about accelerators and how they're different from incubators and accelerators and all those things?
Do you want to take that?
Sure, you're just asking generally about
Yeah.
Any specific aspect you want me to talk about? Or?
I guess if depending what stage of the company is better for what vehicle that you want to get into.
Could I have a couple of opinions. Could I start?
Go first and then I'll
Okay. Sorry. Okay, and I think an accelerator is a new name for an incubator, not so new anymore, but it's the same thing. There are, depending on your needs, so this is one of the financing sources that, has become very popular, and it's almost kind of like the Shark Tank kind of thing. They're bringing to you some value. So most of the accelerators, in my opinion, if you take a look at what percentage they're getting for what they're giving you, it's enormous. Like, some of them, they take 8% of the company for $20,000, but they're giving you a place to work. So what you really need to do, and I go into specifics, is what services are they providing above just giving you rent? Do you need help with your management team and finding talent? Do you need help with the industry? Do they have connections to the industry and to other venture capitalists? Then you're starting to say, that's what do I bring to these guys? Same kind of thing. My Rolodex is part of it. If I know people that are, I could hook up with in terms of that. So if there's particular industries for these accelerators, they have an industry specialty, internet companies, what have you, and they have the connections with the venture capitalists that are the next stage, and they can make the introductions, then maybe it's worth it because you are getting a lot of value. But they differ quite a bit, and some of it is a sham, to tell you the truth. And I think this is why they call theirs a pre-accelerator. They don't want to be associated with that. Am I right?
Yeah, ours is different. They're not intended to be competitive or replacement to that. And I think sort of agree with a lot of what you said, put a different twist on it. There's, just like anything else, there's good and bad accelerators, incubators, right? So there are definitely good ones that I think I've had clients go through and added a lot of value. And they were able to progress along in their business model, and it was much easier for them to raise their next round of money because they went through a really quality accelerator program, provided validation for them, and also the connections and all that kind of stuff. But there has been, and it's sort of, I think we're on the backside of the curve now. Like if you go back a few years ago, especially in LA, there was like a huge explosion of all these accelerators and incubators. and a lot of them are not that high quality, so you do have to be really sort of analytic about it and do your diligence before you go into one of those programs and give them equity. And I think now, like I said, we're on the backside, so some of that's kind of shaking out. And there's definitely some, high quality ones in LA and definitely in the Bay Area and around the country that I think can add value, but not all of them for sure.
Look, here's one area where if you have a really good idea, good team, very well thought out, and you go to these people, you can talk to them, you could talk to who went through their accelerator already, what they're going to offer, what their success rate is, all those kind of things, and you could shop for them. Same with venture capitalists too, or early stage venture. What do they do? If you talk to the Tech Coast Angels, they're going to pitch you on what they would provide, and you go to another one and another one. So it's about you choosing them as well too.
Yeah.
Yeah.
Yeah, and today you can get, as Darryl said, you can get all that information, like VC firms or accelerators. You go on their websites, you go on LinkedIn, you can find all the companies that are their portfolio companies. You can probably find someone that you know or someone that you know knows that works out in those companies.
Since you said that healthcare takes a lot of funding, have you now become shy of investing money in biotech and healthcare?
Oh, I would never do it again. Well, I'd never do it again. I mean, these are big, our biggest investment now is Medicus. And it's kind of because I'm CEO and we keep on just funding and funding and funding. And it's something you need big, deep pockets for. I think that Medicus has a tremendous potential still. So we're with it. And so it's not true that I wouldn't do it again, but it's just like my learning curve has gone way up after being CEO for 4 years of the company. I now know what it takes. But to tell you the truth, we didn't know what it took. Oh, and by the way, the reason why, somebody's making copies. The reason why we made that investment in Medicus, remember I said, why do we make investments? Well, it turns out that the family in Argentina are really into cancer treatments. They are funding a Nobel Prize winning cancer candidate in the cancer protein field. And when they heard we had this opportunity, it was more because of that than the financial aspect of it. So that's why we jumped in without, quite frankly, doing the amount of due diligence I usually do, because they wanted to do it anyway. And they wanted to continue anyway because of it. And I'm glad.
When companies come in and show their financial projections, oftentimes as an investor you look at them and they're a lot higher, or they're matched to hit a hurdle rate that you want to see and expected, and then sometimes you just throw them away as inaccurate. And so in many ways, companies come in and purposely make financials that they know you're going to be happy with just to make you guys happy, but in the same sense that they almost feel forced to do it. And so do you ever feel good about when a company comes in with a more conservative approach?
More realistic, put it this way. Well, there's a big difference between realistic and conservative, because I see a lot of students especially, they'll come and they'll do a BCO or they'll work through their business and they'll say, oh yeah, in year 5, I'm going to make $1 million in sales and I'll have $100,000 in profit. I say, why are you doing it? And what are you going to, what for? What's the purpose? And they say, well, we want to make sure we deliver on our promises. So, there's a too conservative and a too optimistic. And I think it's just a matter of really proving the assumptions in there and making you feel that it could work. So Micropower, where I said, God, everything seemed perfect, and I couldn't even put a hole in it, but I knew it wasn't going to happen. So it is what it is, Yeah.
This is really funny to mention this, because I used to have this scenario that he just set up. I remember I sent him my financials. He's like, what are you doing? I said, well, I don't want you to think I'm like living in Oz here. Like, I want to have some reality here. He's like, you are never getting funded if this is do you believe this is what your business is going to do? I'm like, no, of course I think it could go to the moon, right? He's like, well, you need to find a way to kind of still show that you are a sane person without multiple personalities, and give us some financials that we can digest here. However, I will say this, my internship at VCA was interesting because I had the opportunity then to be on the due diligence side, and all of these seasoned investors, angel investors, it always came up, people, and it was always a joke. It was always like, well, here we go, here's the hockey stick, ha 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 ha. But it became this thing of like the financials. This is the way I've come to view financials as a young startup. When you come in the door to anybody asking for money, that again, smart money, is that it's sort of like if you're an investment banker, right? No one's gonna look at you weird if you come in dressed in a suit. It's expected, right? If you come in jeans, they're gonna look at you weird because you're not dressed appropriately. And that's the same thing with these financials that frankly, more times than not, are like baked in fantasy land. You need to come in the door with them, whether they're like outrageous or not, and frankly, because
Yeah, but they have to have the assumptions behind it.
I agree with that. But my point being is like they are, by nature, there is a perverse incentive for them to be optimistic. They have to be. They have to be.
I have a little bit different spin because I've pitched a lot of different types of investors, and what I've come to the conclusion is that it's like selling anything else. It depends on who your audience is. And it depends on how much they're gambling, right? So institutional VCs are making big bets on big gambles, and they need to see, I had one tell me point blank, if you don't have projections that show $1 billion in organic growth, we're not even talking to you, right? They're looking for the Skypes and the Beats and the Googles. Now, if I go and I talk to a family office or a high net worth investor, they have different incentives, different motives, and their approach to investing is a lot different, and their expectations of what they're going to get in an investment packet and in the set of projections is going to be, and the underlying assumptions.
And if they see $1 billion valuation, instantly skeptical.
Yeah,
right? Like you've done the opposite.
So who are you? So the first question you have to ask yourself is, how much are you trying to raise, and from who, and at what stage are you? And then that I think starts to define your offering materials and your package and your pitch and your projections and all of those things.
But it's funny. Yeah, and that's a good answer. But there's also the reality, and the reality is that you have a conservative estimate and you have an optimistic, or a baseline and a more optimistic. And sometimes they're so huge because you're so early stage and you really don't know. And it's actually true, So you have to just kind of you really have to give it your best shot. And a lot of your credibility comes into showing what those projections, why those projections will work. It's more not about what the projection is, it's what your thinking is behind the projections that really matter.
Yeah, I was going to say the same thing, because what everyone knows is those projections are going to be wrong, right? You're right. So it's more demonstrating that you've thought about your business and how it's going to grow and being able to show that.
And the reason that they want them to be so big is because they're heavily discounting them at time zero, right? So to your point. Yeah.
Just go
Question for MIQ again is, it seems like you're looking for other funding elsewhere. How do you find those types of investors that you're looking for as opposed to?
So then we've purposely chosen the harder route because it's more difficult to find high net worth individuals and family offices that are at their right stage of investing and looking for the right type of opportunity, right? So it's kind of matching it up. And then you've got to go and you've got to pitch a bunch of individuals. But what you end up with is more autonomy and a lower price for the money. And so it's difficult. And so in part, it's a lot of networking. We are fortunate because our management team, and so I've purposely have identified managers and board members that have a Rolodex in that regard, our CFO in particular. But then what that means is I'm getting on a plane and I'm flying down to Jackson, Mississippi to do a 4-day tour and dog and pony shows. So I guess that was a long answer to the question, and the short would be networking is the way to do that. The venture capitalist, the institutional money, that kind of stuff is easily identifiable. It's finding the pocket of the guy that just cashed out for the oil deal that's sitting on $200 million, and he's going to dedicate X% of his net worth to risky investments, and how much of that pool does he still have left, and how many other transactions is he looking
And
at?
how many vacations is he taking, and how many vacation homes is he buying, right? Like it's a fickle group. It's a difficult challenge. Yeah.
But you don't end up with 25% of the company at the end, right? So if you can get to start cash flowing your business from sales, and you can stave off the institutional money, then you can end up with
And it's more so that I think the institutional money wants to put in more money than you need. I think the reason is.
But I'm happy to take $20 million today, but not at 80% of the company, right?
Well, that's what, but you need to take less it might be the same valuation, but you're taking less money now because you don't need that much money now. So you're getting all this money that you don't need from those kind of sources.